Good morning. This is Larry McMillan with a market update on Monday, April 21st. Hope you enjoyed the Easter holiday weekend. And if you're in Europe, you're still enjoying it. You're off on Monday. The S&P chart still looks negative. We're still in a pattern of lower highs and lower lows. The rally that has taken place so far has not even reached the 20-day moving average, which is sort of the minimum requirement for an oversold rally. So while it seemed like it was a great distance, and it was because we were very oversold, the chart is still negative. There's resistance in the 5,500 area. That 20-day moving average is just above that. If we were to climb above that, there is a potential for a McMillan volatility band buy signal at 55.75. But above there, there's still some problems. There's the declining 200-day moving average and other things. For this to be an all clear for the bulls, we would have to climb above 5,800, which I think is going to be pretty difficult right now. Later on, breaking the downtrend line is probably more feasible. On the downside, we have support in the 4,900 area, 4,850 to 4,900. And that is the lows from a couple of weeks ago. Equity-only put-call ratios are split. The standard ratio continues to climb, so that's a bearish sign for stocks. The weighted ratio has been trying to roll over to a buy signal, but it hasn't really been too convincing in doing so. And so we wouldn't really take a position based on these contra indicators until they're in agreement. Breadth had improved last week, and it was jumping back and forth between potential buy signal and not, and then that's where we still are, potential buy signal, but not confirmed yet. So if breadth were positive today, which doesn't look like that's going to happen, we would have a buy signal there. But if breadth were to improve, let's say for 2 consecutive advancing days, then I think we probably could get a buy signal from the breadth indicator. New highs versus new lows, that remains bearish as new lows continue to dominate new highs. So that brings us around to VIX. VIX is way off its peak, so that's a spike peak buy signal, and that's in effect right now. But the trend of VIX is still higher, and that's bearish for stocks as well. So we're running positions based on both of those. In fact, that spike peak buy signal is still really the only buy signal of intermediate term quality that we have in effect right now. There is a short-term buy signal based on breadth, but that actually expires tomorrow, so we can't rely on that too much. So the last thing to look at is the construct of volatility derivatives, which is the term structure of the VIX futures. That's negative. That's remained negative now for a couple of weeks. This is the longest negative period we've seen from this indicator since March of 2020, the pandemic sell-off. And so this is not a good sign. I mean, we really need to see the term structure roll over and begin to slope upwards in its more traditional bullish stance. But until that happens, caution is still warranted overall. So, sorry, the news is a little more bullish if you're bullish. If you're bearish, maybe it's good news. But it doesn't look to me like the bottom is necessarily in yet. Certainly, we have not broken the downtrend of lower highs, and that's going to take some work to do that. Once that's done, then we potentially could look at buy signals. But right now, the S&P chart remains negative. So I invite you to visit our website, take a look at our daily letters, so you can keep up to this stuff with this stuff on a more timely manner. And meanwhile, have a great trading week.